This video will help you understand how to avoid an underpayment tax penalty. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Bottom line, the IRS expects you to make regular tax payments to them based on the income you receive throughout the year. However, if you fail to meet the minimum requirements to pay said taxes, you could absolutely get hit with what's called an underpayment tax penalty. To avoid this payment, you can't just wait until the end of the year when you file your taxes to pay all the taxes you owe. You have to do some reverse engineering to make sure you're on track to meet your obligations. So in today's video, we'll walk through how to avoid getting hit with an IRS underpayment tax penalty. So let's jump in. A lot of people incorrectly assume that your taxes to the IRS are due when you file your tax return, either by April 15th or if you extend all the way till October 15th. In reality, your taxes to the IRS are due as you earn it throughout the calendar year. Now, most of you who are probably W-2 compensated don't directly see this withholding occurring unless you review your pay stub, but HR and payroll are withholding money for you throughout the year. If you're self-employed, however, that job is entirely on you. Now, you could outsource this to your own payroll department, but if you're completely self-employed and doing all the financials yourself, technically the IRS is expecting you to make estimated payments to them at least on a quarterly basis. When you file your tax return, however, that's just when all the math equals out to find the exact perfect amount of taxes owed or refund that's owed back to you. To clarify additionally though, avoiding an underpayment tax penalty doesn't necessarily mean that you won't owe any additional taxes when you finally file your return. Likewise, avoiding an underpayment tax penalty does not negate whether or not you'll be entitled to receive a tax refund. Avoiding underpayment tax penalties and whether or not you're entitled to a refund or you owe money are independent equations. That being said, if you successfully avoid an underpayment tax penalty because you withheld throughout the year in an accurate fashion, you'll probably be pretty close to the mark as to whether or not you're going to owe or be entitled to a refund of a very small amount. You're going to be really close to the total amount of exact taxes due. Now, before we get into the specifics on how to calculate an underpayment tax penalty and kind of how the IRS views all this, if you just want to jump ahead to some simple best practices, I'll timestamp that down below. So what is an underpayment tax penalty? Well, definitionally speaking, it's when you as a taxpayer did not withhold enough on a regular basis to the IRS based on the income you received when you received it. Said another way, you can't just earn all your income for 12 months and then stroke one big check to the IRS on December 31st. You're supposed to be making estimated tax payments to the IRS throughout the year as you earn said income. The IRS actually publishes the schedule on which they expect you to make your estimated tax payments. And while at first glance it might appear to be simply quarterly, the math doesn't actually add up to it being a perfect and equal quarterly installment. So for example, the first payment that you owe to the IRS is going to be on April 15th of the current calendar year. And that's for any income you received between January and the end of March. You'll estimate your taxes for that period and you'll owe the tax bill on April 15th. The next quarter, however, only spans from April 1 to end of May, which is 2 months, and that estimated tax bill is due on June 15th. The next installment is a 3-month quarter, which goes from June 1 till the end of August. And then that estimated payment is going to be due on September 15th. And then for the final installment throughout the year, you're actually going to span that from any income you received from September 1 through the end of December. Your tax bill for that will be due on January 15th of the following calendar year. So while it might appear quarterly at first glance, it's technically not quarterly. And we won't get into why that is, but essentially the IRS expects you to be making regular installments to them based on how much income and estimated taxes you project. To perfectly do the math as to what you're estimating for a tax payment, you can refer to a form of 1040-ES, and you'll use that 1040-ES or estimate to calculate how much you'll owe at the end of that respective quarter or time period. And then once you've figured out the total amount you'll owe for that period, you have a number of different ways in which you can pay that money to the IRS. And I'll link down below to the various methods that they approve. You could send in the mail, you could send a check, you could send cash, you can wire the money, or you can use a number of different electronic payment methods. There's a direct pay function where if this is like a one-off thing, that might be the easiest. Or if you anticipate continuing to make regular payments, you could enroll in their EFTPS system. which is essentially like their online portal for making payments on a regular basis. And personally, that's what I use. I suspect the IRS requires these regular payments for a couple of reasons. Financially, they probably appreciate having ongoing income and sort of a pay-as-you-go system that a lot of other functions in the government are based on. Plus, from a reporting standpoint, it's probably a little bit easier to project what income is going to look like for the IRS throughout the year if they're getting regular installments, rather than if only once a year they're supposed to be getting a big old check and they have to project that out for the next 12 months. And that's because essentially if all taxpayers simply just had to wait until April 15th to figure out how much they owe the IRS, I bet you'd get a lot more people behind or short on the total amount of taxes owed, rather than requiring them to withhold money on a regular basis. Analogously, you could think of like a mortgage payment of $5,000 a month. If your mortgage is $5,000 a month and you only had to pay it once a year, what are the odds that somebody would miss that mortgage payment if on January 1 every year, the mortgage company came knocking and said, where's our check for $60,000? And if you don't pay it to us, we're gonna seize your bank accounts and everything else that the government can do. It's probably a little bit more digestible to make equal $5,000 a month payments. So how much is the tax and how is the tax calculated? Well, you're gonna need to know three variables. The first one is what is the total amount that you're short by? The second thing you'll need to know is in which quarter were you short on that payment? And you'll need to then refer to the IRS's table for interest rates. I'll link that down below, but to keep it simple, for 2025, the interest rate is 7%. What that means is you are charged interest every single day, annualized to 7%, until you pay off that owed balance. For example, if in the first quarter, when payments are due on April 15th, if I'm short by $10,000, or I did the math wrong and I actually owed 10 grand more than I paid on April 15th, then my interest to the IRS will start accruing since the end of that quarter. Now, theoretically, I don't make up for that $10,000 elsewhere in the year. When I go to file my taxes in April, then I will owe $10,000 plus 7% interest on that $10,000, which is $700 additional in underpayment tax penalties. Now, normally someone doesn't actually owe a full 12 months of interest due, because if they missed an estimated payment, it probably happened later in the year, and or if they filed their tax return before April 15th, then theoretically, even if they were short on that first quarter, they would still owe less than a full 7%. But theoretically, someone could have a more than 7% interest rate if they owed taxes at the end of the quarter of 10 grand, let's say, and then they filed an extension and they didn't pay their taxes due. Remember, all taxes are due and final by April 15th, whether you extend or not. So theoretically, if someone was thinking, I'll just extend to accumulate some more money before I pay all my taxes, well, that's actually an incorrect assumption, because all your taxes were due on April 15th, even if you extend when your return is due. Theoretically, that person could be accruing interest for longer than 12 months, if it's longer than 12 months since they owed the IRS that first underpayment. Now, what are some ways to avoid this tax entirely? Well, you might be thinking, all right, well, I'll just do 1040 ESs every quarter for the rest of my life. While yes, the 1040 ES, again, is the Boy Scout answer, if you're self-employed, you could actually implement what's called a safe harbor strategy to avoid an underpayment penalty. Technically, everyone's entitled to use the safe harbor rule, but I just find it's most applicable to self-employed folks who are in charge of doing all this tax math on their own. A safe harbor, for simple definition, is essentially a strategy the IRS is blessed off on, saying, if you do this, you will not owe an underpayment tax penalty. And in my opinion, this is the simplest way of solving for avoiding an underpayment tax penalty. Number one, if your adjusted gross income for the year is less than $150,000, you simply just need to withhold 100% of the taxes due on last year's return. Contrarily, if your adjusted gross income is above $150,000, then you actually have to withhold 110% of the taxes due last year. Personally, this is what I do, and whether somebody is on the lower or the higher end of that $150,000 threshold, I'd probably still advise they withhold 110% just to be safe. I look at last year's taxes owed, I take 110% of that number, I divide it roughly by 4, and I pay the IRS the estimated payments based on the due dates they outlined on their website. Now, does that solve for an underpayment tax penalty? Yes, it does. Does that solve for me being on the hook to owe the IRS more money on April 15th? No, it does not. And if my income does go up a tremendous amount, good problem to have, if I don't withhold more, I'll probably be on the hook to stroke a big check come April 15th. To plan around that, however, I not only take 110% of last year's taxes owed, but I plus that number up a little bit just to be safe. Theoretically, if my income quadrupled, I'd probably be on the hook to make a big payment. I'd avoid the underpayment penalty, but there's also a good problem to have, and it hasn't happened yet, but here's hoping. Technically speaking, if you had the cash in reserves, you could stroke a check to the IRS on January 1 for the next calendar year, as long as that check equals 110% of the taxes owed in the previous calendar year. You could do that. The downside is that money is now gone, and from an opportunity cost standpoint, you're not accruing any interest on the money you already sent to the IRS. So that money's long gone, and at a minimum, in a high-yield savings account, you could have been earning about 4% or so in interest over the next 12 months. That said, the IRS does say that they will accumulate interest for you if there's an overpayment, but they don't start calculating that overpayment interest until the tax return is actually due in most cases. So on April 15th, that's when they're going to start the math, but you've been out of pocket with that money from January of last year all the way through the year up until April 15th of this year, for example, if you decided to prepay your underpayment tax penalty safe harbor amount. So what are some circumstances in which you would be granted an exception for an underpayment penalty tax? Well, this is beyond like appeals and things like that or amended returns. That's beyond the scope of today's video. But of course, if you've had a drastic change in your financial situation, a lot of times you can appeal to get that underpayment tax penalty removed. I'm talking about things ahead of time. Number one, if you had no tax liability last year, the IRS is not expecting you this year to perfectly withhold taxes throughout the calendar year. In addition, if you did all the math and you ended up owing less than $1,000 in difference from what you withheld throughout the year to what you owe when you finally file your taxes, no underpayment penalty will apply. And then lastly, if you are within like 90% accuracy for the total amount of taxes due on April 15th and the amount you withheld throughout the calendar year, the IRS also looks very favorably upon those metrics. In addition, if you did one of the safe harbor contributions we talked about a second ago, you're obviously in the clear again. But one thing that definitely will not get you an exception from the underpayment penalty tax is filing for an extension for your tax return. Remember, the due date of your tax return is not necessarily when all your taxes are due. If you file for an extension, all of your taxes are still due on April 15th. Just the actual filing of your completed return won't be due until October 15th. So what are some best practices moving forward? Well, first and foremost, I would say if you're self-employed, I'd highly recommend committing to the 110% of last year's taxes owed safe harbor math. Basically, take 110% of the taxes owed last year, divide it into 4 installments based on the IRS's deadlines, and just plan to submit that. To me, that takes out all the guesswork. The only caveat I would add here is on each installment, vary the number slightly and then track which quarter that number was for. For example, if 110% of last year's taxes owed for you was $40,000, as opposed to simply doing $10,000 chunks to get to 40 grand throughout the year, I would vary it with the first payment maybe being 10 grand, the next payment being $10,001, the next payment being $10,002, and the final payment being $10,003. Yes, you overpaid by a couple of dollars, but you varied the payment. So if ever there's an issue with tracking down that payment, it's a lot easier to track down X quarter's payment with Y money when every payment is different. Now, if you're mostly W-2 compensated or most of your income comes from Social Security, pension income streams, or distributions from a retirement account, then I'd highly recommend speaking with payroll or whoever handles the withholding and simply just bumping up those numbers. Worst case, you get a bigger tax refund this go around, and then you can right size for next year. Lastly, if you get a large lump sum throughout the year, a big bonus, or you cash in a bunch of stock, for example, in my opinion, it's best to withhold taxes manually at the margin, unless payroll is going to do that for you. But for example, if let's say you just reached the highest income tax bracket of 37%, whatever that big lump sum is, just withhold it at a straight 37%. Don't try to get fancy with an effective tax rate, because theoretically, if your income just reached the top of the 37% bracket, any additional income will entirely be subject to 37%. And you might have some ancillary taxes like net investment income tax, which I'll link above to explain a video here. But there could be some ancillary taxes on top of that. In my opinion, it's best just to withhold at the top of that margin. Now, I know a lot of this flies in the face of what maybe like Reddit engineers would look at as far as, well, you don't want to overpay the IRS too soon because then you're missing out on money throughout the year and you're giving them a tax-free loan. In reality, I have found from a behavioral standpoint, it's a lot easier to have something systematic and consistent to stick with rather than doing a bunch of math every single quarter. Most people just simply aren't going to do that. And the best financial plan is the one you're actually going to execute. So I'm a big fan of skewing more towards what's simple and executable rather than what's fancy and, mathematically most optimized way of paying estimated taxes. So hopefully that was helpful. From a calls to action standpoint, check last year's tax return. If you did have an underpayment penalty, figure out a way that abides by these rules to get you in the clear for this coming tax year. Technically, whenever you're watching this, unless it's January 1, it's possible you might already have an underpayment penalty accruing from a previous quarter. So just do your best moving forward, and hopefully this has been a little bit helpful in shedding some light on how to avoid an underpayment tax penalty. Have an awesome rest of your week, and we'll talk to you later. Bye.